Welcome to TickerWatch. This week for Alphabet, the artificial intelligence narrative faced a major test. The company is staring down a landmark lawsuit over its Gemini chatbot, raising new questions about AI liability. At the same time, it inked a massive deal to power Apple's Siri, a move that could redefine personal AI. The stock felt the pressure, closing the week down more than 4% and slipping below the critical $300 support level. With bulls and bears digging in, the big question is, are Alphabet's massive AI investments a clear path to growth or a source of mounting risk? This is TickerWatch News for Alphabet, Week 10, 2026. This episode covers the major headlines and market developments for the company as it navigates a complex environment of new AI partnerships, increasing capital spending, and significant legal and regulatory challenges. Stock snapshot. It was a tough week for Alphabet shareholders. The stock began the week at a closing price of $311.76 and ended at $298.52. That represents a weekly decline of about 4.25%. This drop was sharper than the broader market's performance. The S&P 500 fell just under 2% for the week, while the tech-heavy NASDAQ 100 was down about 1.25%. The takeaway is that Alphabet significantly underperformed its Magnificent Seven peers and the wider market as investors wrestled with a mix of company-specific news and macroeconomic headwinds. Top news and headlines. The week was dominated by developments across Alphabet's artificial intelligence and services portfolio. First, the company's autonomous driving unit, Waymo, continued its expansion. It's now operating in 10 cities, including recent rollouts in Dallas, Houston, and Orlando. The company stated it's on track to serve over 1 million rides per week by the end of the year. However, this growth is happening under a cloud of regulatory scrutiny. The National Highway Traffic Safety Administration is investigating over 3,000 Waymo vehicles following several incidents, including collisions. Next, Alphabet's AI chatbot Gemini became the subject of what is reported to be the first ever wrongful death lawsuit involving a major consumer AI product. The suit alleges the chatbot contributed to a user's suicide. This case raises new questions about liability and safety for AI developers. On the other hand, Google's AI is also being integrated into healthcare. CVS Health announced a partnership to build its new Health 100 platform on Google Cloud, using Gemini models to power a real-time consumer engagement service. The company's spending also caught investor attention. Alphabet's 2026 capital expenditure guidance of $175 to $185 billion is drawing concern over near-term free cash flow. This AI-driven build-out has prompted the company to issue a significant amount of new debt, part of a broader trend among tech hyperscalers collectively borrowing over $1 trillion to fund data center construction. Finally, in a major shift for its mobile ecosystem, Google settled its long-running antitrust battle with Epic Games. The agreement includes lowering Play Store commissions for subscriptions and e-commerce transactions to a range of 10 to 20%. It also establishes a process for alternate app stores to get a certification from Google, potentially making it easier for users to install them. Market reaction and investor sentiment. Investor sentiment around Alphabet was decidedly mixed this week. While the stock fell below the key $300 support level, some analysts remain constructive. Bank of America reiterated a buy rating with a $370 price target, and TD Cowen maintained a buy with $365, citing growth in the Waymo unit. However, the narrative tone has become more cautious. The primary concern among investors appears to be capital allocation, with the massive 2026 spending plan creating uncertainty about near-term cash flow. Legal headwinds also weighed on sentiment. The wrongful death lawsuit involving Gemini, a separate wrongful death lawsuit involving the Gemini chatbot, and the ongoing regulatory review of Waymo were all noted as sources of caution. Prediction markets reflected this mood, pricing only a 39.5% probability that Alphabet would close above the $300 mark by March 9th. The price action aligned with this bearish sentiment as the stock failed to hold that level. Technical and fundamental check-in. From a technical perspective, Alphabet's stock shows signs of negative momentum. The share price has spent the longest stretch below its 50-day moving average since early 2025. It is now testing the low set in December 2025, around the $296 mark, for the third time. This level is acting as a critical support zone. The weekly Bollinger Band mean, a measure of trend, sits near $308, which may now serve as a resistance level. On the fundamental side, the story is a tale of two conflicting narratives. On one hand, the company's growth versus risk profile is being questioned due to the enormous capital spending plan for its AI build-out. This shift towards an asset-heavy model could lead to lower equity multiples over time. On the other hand, the underlying business remains incredibly strong. Operating earnings grew nearly 28% year-over-year in the last quarter, with operating margins near 25%. The strength of these fundamentals was highlighted by Berkshire Hathaway recently adding a significant position in the company. What to watch next week? Looking ahead, there are several key themes to monitor for Alphabet. The market will be watching for any new developments in the legal cases involving the Gemini chatbot and the final court approval of the Epic Games settlement. Continued scrutiny of Waymo by the National Highway Traffic Safety Administration remains a key factor. The most critical element, however, will be how investors continue to interpret the company's massive capital expenditure plans. For price levels, the $296 support level is the key area to watch. A break below that could signal further downside. On the upside, reclaiming and holding the $300 psychological level, followed by a push towards the $308 resistance area, would be a bullish sign. The bull case is that the market begins to view the heavy spending as a necessary investment for long-term AI dominance, and new partnerships show a clear path to monetizing these investments. The bear case is that legal and regulatory pressures intensify, and fears over spending continue to weigh on the stock, pushing it below its current support. The base case sees the stock remaining volatile as the market balances long-term potential against near-term costs and risks. Thank you for tuning in to TickerWatch. This podcast is for educational and informational purposes only and does not constitute financial advice. Please consider subscribing, leaving a review, and sharing this episode with others interested in the latest developments for Alphabet.